The financial statements convey a lot of useful information that helps corporate managers, creditors, and outsiders like potential investors assess the company's strengths and weaknesses and gauge the expected impact of various proposals. In previous video, I already discussed the most authentic source where you can obtain financial statements for any public company from. Just in case, the link to that video is in the description below. Financial statements supply you with an overwhelming amount of information. Thus, you need to know some analysis techniques to make the information meaningful and make a quick evaluation of a company or across the companies. Ratios help us evaluate financial statements. You can calculate many ratios using financial statement data. I am not going to discuss all these ratios individually. I would rather talk about the main categories that these ratios fall under. Ratios are divided into 5 categories. Liquidity ratios give an idea of the firm's ability to pay debts that are maturing within a year. Examples of ratios are the current ratio and quick ratio. Creditors from which the company borrows money could be interested in these ratios while evaluating the company. Asset management ratios give an idea of how efficiently the firm is using its assets. Examples of ratios are inventory turnover, day sales outstanding, asset turnover, and many more. These ratios could be of interest to managers, stockholders, and potential investors. Debt management ratios are a set of ratios that measure how effectively a firm manages its debt. Ratios that belong to this category are debt to capital and times interest earned. These ratios could be of interest to managers, creditors, stockholders, and potential investors. Profitability ratios give an idea of how profitably the firm is operating and utilizing its assets. Examples of ratios are profit margin, return on asset, return on equity, etc. These ratios could also be of interest to managers, stockholders, and potential investors. Market value ratios give an idea of what investors think about the firm and its future prospects. Ratios that belong to this category are price to earnings or PE ratio, book to market, and many more. These ratios could also be of interest to managers, stockholders, and potential investors. Sometimes, competitors can also look at these ratios to assess the company's strength. When you are done calculating a financial ratio, the next step is to compare this ratio with the benchmark ratio. This benchmark could be the industry average. You will then be able to see how a company is doing compared to other companies in the same industry. This comparison is called cross-sectional comparison. On the other hand, you can also compare a company's ratio with its own past ratios to see how this company is doing over time. This comparison is called time series comparison or trend analysis. The ratio analysis is also subject to many limitations, such as comparison with industry is difficult because a company can belong to many industries at the same time. Companies follow different operating and accounting practices. Sometimes, it's hard to tell if a ratio is good or bad by simply looking at the numbers. Overall, there could be many company-specific qualitative factors such as seasonality and competitive space that you must pay attention to while performing ratio analysis on a company. Analysts who consider all these factors would be better evaluators of a company. Thanks for watching this video.